Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. What I've got here is I'm going to talk about some comments that people are leaving. One of them is a question. I'm just going to go on here. It says, Andy, do you hold any cash on hand for buying the dip in commodity stocks due to a market correction? I usually what happens is I find opportunities and I deploy the cash. So I do not have a large cash balance if the opportunities are there. I jump on them. So I do not sit on cash if I like the setups. And right now, I've been finding setups across the board that I like. So I've been deploying as much cash as I can get my hands on. And those setups, like Intrepid Potash, that's one I was buying recently. I bought Altius Renewable Royalty. When that was down, I bought into it. And I'm going to tie this together with another question. The other question is, I'm curious if you use market or limit orders for your purchases or have other methods of securing the prices you want. I use limit buy orders, but it doesn't mean that I necessarily put it way below the market. I put a limit buy order on everything. I hardly ever do market orders because I want to limit what the market maker can do. And I'll say I agree to buy it at this price, but I don't want to buy it, 10 or 20 cents above it if it's a smaller company where it could be a 10 or 20% price swing. So I put in a limit order and try to hold that limit line. Now, what I do is I'll look at a chart. I'll kind of look at one here and kind of get in there and tell you and describe to you what I do. It doesn't mean what I do is necessarily right, but I'll help you guys with a potential of at least of what I do. So I'm pulling up REMX. This is an ETF. It's a rare earth metals ETF, and I'm going to back way out. I call this the double booty bottom. This is actually a Wyckoff distribution bottom where it comes on down, it comes up, it comes back. This is called the spring. It springs and then it springs up higher. We've broken this. It usually does a little bit of a zigzag back and forth here. And then I think we'll see a big potential move higher. So what I did here, just to show you guys, I'll go to a daily. Yep. So I bought it at the tip of this guy right here at $86 because I recognize this breakout. I actually shared it on the channel with everybody, REMX, and I put a limit order in this section on the tip here because I saw it ready to break and moving on up with good buying pressure. We had the break, we came on up, and it happened to work out this time. Sometimes it doesn't work out like that. But from a long-term perspective, I'm a big bull on rare earth metals. Rare earth metals go in the magnets of these of electric vehicles, cars. And I don't know if there's any replacement for it. I think this is kind of it. And last bull market in say the 2011 timeframe where it peaked out, some of these rare earths did absolutely incredible things. It dwarfed what gold and silver did. So I'm loading up on the rare earths over time, and I've been buying that. Another company that I look at and how I transact in it is like, say, Appia rare earth, and I'm just kind of sticking on the theme here. So here's Appia's chart, and I've bought in throughout a whole bunch, but remember that double bottom, the come up, and then the spring. This one has it as well. It's springing back up. It came up. It usually does like it puts in a pattern, somewhere right above the breakout usually. This is the pattern there, and it broke out and kept running. I'm a still bull on this. I'm very bullish on it, and I didn't draw it quite where I should have. But there's the breakout there. We're coming on down, and I would still be even a buyer in here of Appia Energy because they've got rare earths. They're very high percentage, and I've been holding this for a long time. And I'll add in here now. When this thing kind of contracts down and starts to turn back up, that's when I fire off a buy. I don't put like a limit order down here and try to have it fill. I just put a limit order that day right at the price, and I buy it. So I don't try to pick things off with limit orders like at the bottom per se of this one. LTBR, like Lightbridge, I bought a little while back. I bought that one at like $6 or something like that in the sixes. And we're still there at the six. It's still a good deal. And if you notice, we've got big buying pressure, big bullish engulfing here. And I would fire it off right now. It's got small little selling pressure here, big buying pressure with the bullish engulfing. This looks like it's ready to head higher. I wouldn't be trying to get it at this line down here at, based off where it is today. I would just go in and buy it and ride it higher. At least I think it's going higher. And the company, the reason I'm bullish on this one is in the long term, we're way down here and we've broken the downtrend line to the upside. We did a retest, and that's what we're doing is retesting. We've got a bunch of support underneath it. I think it's a low risk entry point for a long-term hold. So I just go in and I fire the buy order right off if it's at a price I like and it looks really good. I don't try to put it too much below where we're at today. And even like something like an SM Energy looks fantastic for a move higher. And it's coiling up right in the corner here. If I zoom in, it's coiling up in the corner like this thing's ready to break to the upside and move. I mean, if we get a break here, we could see a large move higher. So, I mean, I wouldn't try. I mean, it all depends on how you guys try to do it. But I try to get the lowest price. I mean, what I got on this one was $1.50. It was right here. And I can kind of show you. I bought it right in this section in here. I call it the dead period. We were ready to break, and I was like, oh yeah, let's break. And then we came back down. I've actually bought more. I got in at like $1.42 again on this day here. Too bad I didn't get it like $1.35. That would have been like the ultimate buy point for this pullback here. And then we just rocketed higher like it was nothing. I mean, just look at how this thing went. Absolute. We had a little bit of a pullback down to like 15, and then it just keeps going up. It's kind of fun to watch. Look at that thing go. Oh my goodness. And now we're in the corner here, and we've got a lot of momentum coming up. Things ready to break. Sorry, I love looking at charts, guys. So there's that. So literally, guys, it's not like I put something way below it. I just buy it right there if I like the price, and I put a limit order buy. If on some of these really small companies that, they're like 25 cents or 70 cents or whatever it is, I just put a limit buy of whatever the ask price is. Sometimes if I want it at that price, I put it at the ask, and then it fills right then and there. But it protects me from the market maker making some sort of money, putting it way higher than the bid price or ask price. I should say way higher than the ask price. Because sometimes some of these are pretty illiquid, and if there's not an active order out there, it'll gap you way up to the next order. And some people put like ridiculous high orders, and then they could fill every once in a while, and then it comes right back down. So that's the importance of using a limit order versus a market order on a very small company. It depends on how liquid it is. And usually they're very illiquid at bottoms, very liquid at tops when we're selling, because that's when all the action's going on of it. It says gold acts as a safe haven, and it was bid on Friday due to the war drum beating. That is not new or unusual. That said, I've been waiting for everything precious to get going, given the inflationary area. Is that true? Does it really act as a safe haven? I mean, I guess people maybe... It's not really a safe haven. It's just an inflation hedge. And when inflation goes up and interest rates go up, stocks go down. So maybe that's where it got its safe haven name. But almost every time in history, gold has only gone up when you have a real negative rate, when inflation's greater than the rate of interest rates, and interest rates go up. It forces all the money over. That's when we've had our largest bull markets in gold. So that's the only market condition that it works well in. And it works great because everyone's saying, I need to get out of bonds, and they go into gold usually. And sometimes depending on where the interest rates, how fast they go up and how much they go up, it'll kick out of the stock market as well some of the money, and that money will rotate over into commodities and or precious metals. So I don't know how that is necessarily a safe haven. I guess gold goes down less under market crashes, but I mean, I don't know. I know a lot of people say that. I just know the market conditions, and I don't really worry about what label it gets. It says the difference in the 80s is we still believe the dollar had value. Actually, in the 1980s, people were very scared of the dollar. The early 80s, like 79, 80. A movie called Rollover came out. You should watch that. It's a very interesting movie, and it's a lot tied to gold and how people were afraid of the dollar, and how everybody ran into gold. And of course, that would be the top because everybody's running into it. Moving on down, it says, I'm not an Elliott waiver, but one thing I enjoyed during my study of it was seeing the same kind of news was the cause of the markets going up during a bull market and down during a bear market. Yeah, the news all comes out at the end, guys. Everybody gets all super bullish towards the end of the bull market, and then all this news starts coming out, and it's in the main main news, the main headlines. It's all out there, and that's when you got to be worried, is when a lot of people start talking about it. Cryptocurrencies. When people said to get into cryptocurrencies, I was like, man, everyone in retail's in this, and retail always loses. They always lose, and that's the worst time to get in. So retail was talking about crypto for a couple of years, and I'm like, there's no way I'm going to enter something like that. But when I entered oil, everyone was telling me that oil would never go over $40 a barrel again. That this was it. It's dead. And I'm like, how is that not possible? Like, they're not putting investments in it, and everyone's still using it. I was looking at it like oil is going to go with a zero on the end of that, $400. I mean, I'm an ultra bull, guys. I don't want you guys to. I'm not calling for $400 oil, even though I'm calling for $400 oil. I don't want to be looked at as a crazy person. I just look at ratios and I say, okay, if this were to repeat, and we were to go down to like a 1-to-8 ratio, and let's say at the time gold's at $3,000 or $4,000, I mean, you're at those types of levels for dollars, and it's inflation driven. It's money rotating around. It's liquidity trying to find a home, and that's where you get that whole entire commodity complex moving higher, and everything in commodities is moving higher. It's an inflation move. Money is rotating. Then you've got the supply-demand balance, which is the compression of the ratio. And this thing's going to compress maybe even to a 1-to-6 ratio. So if you go to like a 1-to-6 ratio and gold, let's just, I'm just talking ratios and what history has done. Let's say you're at like $3,000 and you divide it by 6, that's $500. So, I mean, that's within the realm. That's historical norm. I know one guy had a question up here, and hopefully I didn't. Why do you think housing price will do well when interest rates go up? So it's not, the interest rate isn't what. This is where I think a lot of people have it wrong with real estate, and I don't know what the reasoning is, but they think that the interest rate's the driver of where things are going. So they say, oh, when interest rates go up, X will happen. In my opinion, interest rates are a symptom of a problem. That's what we've done in history. They're not a leading driver. They should be if they want to control the markets better than what they are. But it chases and follows things. So when we have an imbalance, a market imbalance of the supply-demand imbalance in real estate, that imbalance is what's driving the home prices higher. In the beginning of an expansionary phase, what you're going to see in a very messed up market is no inventory. You're going to have very little homes being built above the average. That's at the beginning of an expansion phase. You're going to have very low days on the market, and then eventually your rent prices are going to surge higher. We're seeing all of this. Eventually, the home builds are going to have to kick up. They're going to have to dramatically increase the home builds, and that's your inflation. in the beginning, since the supply demand is so out of whack, interest rates, the market is not as sensitive to interest rates at the beginning of these than, say, the end. And it also depends on how high these interest rates are necessarily going to go. In the 1960s and 70s, when we had a very large imbalance in the supply and demand, we had interest rates in the 40s at like 2% levels go all the way to 20% at the back of all the way back to the back of the 1970s and 1980 mark. And home prices went up the entire time in an increasing interest rate environment. That was the largest boom in real estate from the mid-1940s all the way till 1980. We went and built so many more new homes with such a larger demographic that the interest rates did not slow down that movement. Now, it is a little bit different today, but it highly depends on how much inflation and what wages do in the system. In the beginning of this move, I don't think we are interest rate sensitive, and especially if interest rates don't go up very much. We are at very low interest rates, the actual absolute value of the interest rate. So I think that there's room to move up, and it won't impact the housing market as much as what most people think. That is me speculating on that. That's everyone speculating on it. Everyone else thinks that interest rates going up is going to completely ruin the housing market. That very well could be. Problem is, we have to see it in the data. We have to see it. Now, when you start looking at some of the people who are making decisions in the system, I know that the person next door is renting. They tried buying a house about a year ago, maybe a little less than a year ago. They could not get one because prices were up 40, 50,000 that they were trying to bid. They were bidding 40, 50,000 over asking price, and they couldn't get a single house. They did not get 6 houses that they went after, and they were aggressively bidding far over the ask price. They said, we're going to wait for the housing market to cool down. At least that was their viewpoint on it, and they rented. They rented that place for $3,200 a month, which is quite high. Rent is skyrocketing here. So now they have to look at it and say, well, I'm paying that amount. I could buy a very expensive house and still have my total payments be less than $3,200 a month. And the home prices are continuing to move way up. The projected one-year home prices in the area that I live in is about 17%. That's what they project. I project that most of the United States will go up between 10 and 20%. That's kind of my guess for the majority. Not every single city will be like that, but there's going to be a lot of cities that are high single digits to mid double digits is kind of where I'm guessing things will be for this next year. So now you're stuck with, do I wait where a home price could go up $100,000 in a year, or do I sit there and rent and pay it out the back end on rent prices? And you could buy the same house that you're in for cheaper. I would just buy the house. That's me. But you have to do these calculations, and they're going to be presented with this either very high rent prices or to buy the house. Now, some people, they're going to be stuck with renting, and they're just going to get squeezed. Unfortunately, I bought mine a while back because I saw it coming. I said, this is gonna be a huge squeeze coming up. So I bought the house many years ago. And I've just been riding it. Not that I wanted to lock in my costs. That's what I want to do. And I knew that renting would be far more expensive than buying if I just locked in my costs. I also knew that if we had a market crash at some point, that interest rates would go lower and I could refinance, that's exactly what I did. Is I refinanced and I dropped a whole bunch of payment down on my interest. So I have a very low mortgage payment, and have my costs are locked in with a 30-year fix. These costs are all locked in if you're doing a fixed mortgage. And some of my friends, they bought in, back when I did, and then they're buying a second house, is what they're doing. I should probably be buying another house as well for a rental, because this market's all messed up. So I think that house prices move up with interest rates going up. That is what history has shown us. under these large expansionary phases. It did it in the year 2000 to 2008. We had an increasing interest rate environment in 04, 05, 06, 07, and then it blew out with all the bad loans. And inventories came back. We were also in a hyper supply phase for the expansion phase. They built too many homes. So the way that I view it is home prices go up with interest rates because that's how the market works. They don't go down when your demand for loans goes up. Interest rates don't go down; they go up. So that's how the market tries to seek and maintain a balance. But I'll stop it there, guys. We're at the 20 minute mark. Thumb up, guys, for the content. Thank you for subscribe to the channel if you haven't already, and thank you for listening. This is Finding Value.